In today's video, I am going to be breaking down my top 5 picks for the best dividend stocks in Canada. Let's get down and let's check out the first one. So this first one is TransCanada, and of course it does seem really interesting because they just had their pipeline canceled in the United States from Biden, but I personally think that that was just an endless money pit because when one president comes in and says no, like Obama, and then Trump comes in and says yes, go ahead, and then you've got another president who comes in just like the first one who says no, which is Biden, you start having the inability to really do anything in that country, and I would have just absolutely closed it as well and said, screw it, I'm done. And they have been averaging 4.2 million shares traded every single day, and their dividend is quite high at 6.08%. Actually, one of the highest dividend payers in Canada. And their CEO came out and said that they are looking into raising that dividend into the future as well, which is quite interesting. Their PE ratio is quite low, kind of on the lower side when it comes to dividend paying stocks in Canada. You generally want to be around that 10 to 15 PE ratio or lower as being a so-called cheap stock. So 5 years ago, their stock price was roughly in that $55 range. It is currently no longer $55, it is currently $57, and you're probably saying, well, what happened? Like, that is not that much of an improvement. Well, actually, they were up to $75 from $55, which is a great improvement considering that they pay at such a high dividend. However, the coronavirus hit, and then crappy oil prices hit, and they ship oil through pipelines, and obviously that just absolutely died and died again, and now of course it's down close to that 50 plus range mark, again 57 as of today. So personally, oil's going to be coming back. Oil is still a massive part of the Canadian economy as well as the world economy, which is why I think it's going to be going back up and testing that $75 range over the next couple of years. We also have to remember that with pipeline companies, they make deals that are not just as of the second. They are making pipeline transportation deals that last years and years. So they are set for at least a couple of years according to their CEO. Now they have beaten earnings 3 out of the last 4 earnings. Of course, the last second quarter earnings was on par, or it was on exactly what the analysts thought. But their last quarter one was just the same as quarter 4 of this past year was just the same as quarter 1 of the previous year, which was just a blowout, and I think that just may be happening again for the first quarter because generally speaking, these numbers don't usually lie, if you get what I'm saying. Not much of an increase here. They think that there's going to be a downward trend of earnings over year. I really doubt that's going to happen. They, of course, rose their analyst expectations year over year, but I'm going to say that that's going to happen again. And when this earnings comes out April 29th, TransCanada's stock is going to start accelerating if they beat it by this margin once again. And of course, in a down year, 2020, they still made bank. They still made a lot of money. Enbridge is the next company. They pay a ridiculous dividend of 7.4% as of today, or at least the time of making this video. Average shares traded of 10 million, so it's very liquid. And their dividend, ex-dividend I should say, was February 11th, so we just missed the recent dividend, but we can always get in and get the next one. The PE ratio is a bit higher at 30, but again, when you're looking at such a high dividend paying stock with a CEO that came out and said, hey, we are looking to increase our dividend, and we are looking to the fact that we have huge growth coming towards us, which is quite interesting that he said that. I think it was a BNN article about 2 or 3 weeks ago. So it's actually quite interesting when it comes to this stock. But let's really check out the chart and see what this all means. So over the 5-year chart, unlike TransCanada, we see Enbridge that's actually decreased over this amount of time. They didn't do all that bad, but then they decreased in 2017 to 18. And then they slowly started to come back until the coronavirus and oil massive terribleness. But, of course, this happened. This part's the same as TransCanada. This increase was also the same as TransCanada. However, I personally think that TransCanada is just a bit better than Enbridge, but Enbridge has that bigger dividend, so you can kind of make decisions for yourself, but also research yourself as well and compare the two companies. The financials are interesting as well. So even though that the CEO said that they are raising their dividends over the next 2 to 3 years, we can see that they have beaten analyst estimates in the first quarter of 2020. Then they just slightly beat them by the second quarter, and then they had massive negative misses over the last 2 quarters. Will this be the same here? Who knows? Personally, if you're looking to buy a pipeline company, if you were to buy into these companies, I would personally be looking at TransCanada first, maybe before earnings. Obviously, never put your whole stack into it at first. See what happens. Maybe invest 25% or 50% of what you wanted to invest in pipelines, and then wait until earnings. Are the earnings good and their stock goes up? That's fantastic. Start loading up until there's a little bit of a dip, and then load up on the dip. From there, however, I think that would be a good strategy for Enbridge, is just to wait until the earnings to see what happens. Next is BMO. BMO is one of my favorite stocks right now. It's made me a ton of money since the coronavirus recession, and of course it has grown back since. Average volume is 2.7 million shares. Their PE ratio is 13, which is roughly around the middle when it comes to the Canadian banks. You generally want to load up on them when they have the lowest PE ratio versus the other Canadian banks. And the Canadian banks are reaching up into the 14 range right now, and there are still a few in the 13, and that is one of them is BMO. I personally think that they could have a massive growth opportunity with interest rates potentially going back up, but also the fact that they are now proven to make money in a recession, which is fantastic. Their dividend is 3.9%. Of course, just like many Canadian banks other than National Bank, they pretty much plateaued from 2017 until 2020. And of course, now they are starting to absolutely destroy with earnings. And we can see this. We can see this with their stock price recently. And I personally think that they are going to have the 3 years of growth that they did not make or do over the next year or so. So I personally think that this stock has a lot of room to run because it did nothing for 3 years, and now they're starting to grow their earnings. So when that happens, I think that there's going to be 3 years worth of growth in 1 year. And we can see this actually right here. Of course, quarter 2 of 2020, they did not beat analyst estimates. However, the last 3 quarters they did, and by larger and larger and larger amounts. Just think, they did this in a recession, not from interest rates, but from your annual fees and ETF fees, as well as mutual fund fees, just the fees in general they're making that from, which is going to happen whether you're in a recession or not. They're going to always have fees. Remember, Apple, when they came out with the iCloud and the monthly fees, and everyone wanted to know, hey, how much is Apple Music making them? How much is iCloud making them? And same thing with Google. Well, now the banks have these monthly fees, and they've had them before as well, but now they're growing them at an exponential rate that I personally really like the Canadian banks right now. BNS is another one that has, I think, potential further growth. They currently trade at 14.6 PE. However, somehow their CEO says that they are a cheap stock. So what does that mean? Do they have more growth of earnings ahead? We're going to have to really watch this into the future. It's actually quite interesting to invest in, especially with the dividend at 4.6%, because their CEO said that he wants to continue to raise dividends as well as look at share buybacks because he thinks that their stock is cheap. So to me, that means buy, Don't know what it means for you, but to me that means buy. High dividend already, they want to raise it even higher, and they want to do share buybacks because their stock is apparently cheap according to the CEO. That's the one to get, I think. Now, of course, average share volume, 4.1 million shares traded per day. That's good. You can get in and out pretty quickly. And over the past 5 years, it's really done not much. It's really just traded within a range of 65 to 80, and then it came back down to 75 before the coronavirus, and now it's back up to 77. Could it reach back up to its all-time high? Well, we're going to have to see. But if the CEO says that it's a cheap stock and he's going to be doing share buybacks, and they were not really doing that many share buybacks, if any at all, at this point, then I think it's got a lot of room to run. As we can see, the earnings has been quite interesting. Of course, they did make money, but not a lot when it comes to 2020. But let's really look at it. First quarter, beat. Second quarter of last year, beat. Third quarter, not so much. Of course, there was a lot of money being put aside for loan losses. That never happened. And then we had quarter four. That was a beat. Quarter one, that was a massive beat again. Will this massive beat happen once more? We're going to have to see, but it is worthwhile grabbing some because they are a solid company. They're one of the top 6 banks. And of course, Canadian banks have always paid a dividend for 100+ years. Bank of Nova Scotia is no different. They've never cut. Over 100 years, they've never cut a dividend. They've also never stopped paying a dividend. So they have paused a dividend at times where they have not increased it, but they've kept it the same. But when you're talking about a Canadian bank, one of the top 6 banks in Canada, you're literally getting gold, because if you look at their history of the last 5, 10, 15, 20, 100, whatever years, it's always gained. It's always gone up. So I personally really like the banks, but even more right now with their potential growth. And National Bank is the last. And National Bank I've actually held for probably the longest out of all of the banks. They were having some issues a few years back. That's when I was starting to grab them up. Back then they were at a close to 6% dividend. Now they're at 3.3% because their stock has just gone ridiculous. But I think that's going to continue. Their PE is close to 14, and again, remember what I was saying, once it starts reaching 15, it starts getting iffy, and I would stay away, but if they've got some earnings growth coming for them, that will actually decrease in the number, and that would be good, and that would prove a future higher valuation. But going from there, 1.5 million shares traded per day, not massive, but still very liquid to get in and out of. And this is what I mean. I was buying them back roughly here, maybe a little bit lower. I think my average buy-in is around $39 or so. And from there, they have had a massive climb. They, of course, topped out before coronavirus, and they were one of the first banks to recover from coronavirus. And, of course, they are at an all-time high of $86, which is crazy if you think about it. You went from $45 to $86. That's almost doubling, and I'm currently 104% higher on my initial investment on National Bank. So this is really telling on what kind of a company they are and what kind of a bank they are. I hope that this video helps you with your choices on what to buy, what not to buy. If it has, hit that like button and subscribe, and I will see you guys again in my next video.